Today, we're going to dig into the latest annual results from Frasers Centrepoint Trust, or FCT, as you probably know them. They're Singapore's biggest owner of suburban malls, and honestly, their performance gives us a fascinating look into consumer spending and the surprising strength of good old-fashioned physical retail. So, let's get right into it. And that's really the big question here, isn't it? I mean, with all the talk about economic headwinds, inflation, and everyone supposedly shifting to online shopping, you'd probably expect a pretty cautious report. Maybe flat, at best. But FCT's story for fiscal year 2025, well, it's something else entirely. The question isn't just how they survived, it's how they actually managed to grow. And boom, here's your headline number right off the bat, a massive 10.8% jump in gross revenue year over year. That is a huge signal that a lot more money was flowing through their properties. Now, a number like that, it doesn't just pull itself out of thin air. There's a real strategy behind it, so let's break it down. Okay, so to really get the full picture, we've got to look at the anatomy of this growth. We're going to start with the two most important top-line numbers that tell us pretty much everything we need to know about their financial health this year. First up, their gross revenue for the full fiscal year, it came in at a super solid $389.6 million. Now, this is basically all the money coming in the door from their properties, mostly rent from tenants, before any expenses get taken out. And from that number, we get to this next critical figure, net property income, or NPI. That landed at $278 million. The easiest way to think about NPI is as the gross profit from their malls. It's what's left after you pay for the direct costs of running the place, like maintenance and property taxes. It's a really key indicator of how well they're actually managing their assets. So when you put it all together, a nearly 11% jump in revenue and almost a 10% jump in net property income, that's seriously impressive. And FCT says this performance boils down to two main things working together. One, a major strategic acquisition, and two, just really strong organic growth from the malls they already owned. Let's start with that big purchase. And I have to stress, this wasn't just some minor portfolio adjustment. FCVT made a huge billion-dollar bet that fundamentally beefed up their dominance in the suburban retail scene. So get this, a huge chunk of that 10.8% growth came from one single really decisive move. FCT saw a chance to consolidate its ownership of one of its flagship malls to go from being a partial owner to the sole owner. And they went all in. And what was this key asset? We're talking about the North Point City South Wing. See, FCT already owned the North Wing, but by snapping up the rest of the South Wing, they now control the entirety of North Point City. This move basically cemented its status as one of Singapore's largest suburban malls and gave FCT total operational control. And the price tag just shows you the scale of this bet, $1.17 billion. It was a massive investment, but one that started paying off right away. Of course, buying your growth is only one part of the equation. Earning it from the assets you already have, that's just as important. Let's see how they pulled that off. Right, because the story absolutely does not end with that big acquisition. What makes these results so powerful is that their existing portfolio of malls also did incredibly well, showing real organic growth on the ground. And this really gets to the heart of it. These aren't just numbers on a spreadsheet. This is real-world activity. You had shopper traffic, actual people walking into their malls, up 1.6% year over year. But even better, those shoppers were opening their wallets more. Tenant sales grew by an even stronger 3.7%. And when your tenants are making more money, you as the mall owner are in a very, very healthy spot. And that leads us directly to one of the most powerful metrics for any REIT, rental reversion. FCT managed a positive rental reversion of 7.8% for the year. What that means is, when tenant leases were up for renewal, on average, the new leases were signed at rates 7.8% higher. In a tough market, any positive number is good. Hitting nearly 8%, that shows you have some serious pricing power. The CEO of FCT's manager, Richard Nang, really summed it up perfectly. He points directly to the resilience of our suburban retail portfolio. This tells you it wasn't just a lucky year, it was the result of a very deliberate strategy that's built around a specific kind of retail. So what's the secret sauce to this resilience? Well, this chart explains a whole lot. A whopping 54% of FCT's tenants fall under essential services. We're talking about your supermarkets, your F&B spots, your pharmacies, the places people depend on day in and day out.
This focus makes their malls way less vulnerable to economic slumps because, let's face it, people always need to buy groceries and grab a bite to eat.
Okay, so they've got a major acquisition under their belt. Their operations are firing on all cylinders. So what's next? What does the future hold? Let's take a look at the outlook from the management team. The official word from the top is that the outlook for suburban retail is still positive. They don't see this strong performance in FY25 as just a one-off. They believe it's built on a really solid foundation of favorable market conditions.
So what's fueling all this optimism? It really boils down to three key things. First off, they expect demand to stay strong, thanks to a growing population with more money to spend. Second, more people living in Singapore just means more customers for their malls. And third, and this is the real kicker for investors, there's very little new retail space actually being built. It's simple economics, right? When demand is high and supply is tight, the landlord is in a great position. All of this brings us to one final, really interesting question to think about. FCD's success is built on everyday essential needs. And as our lives change, with things like hybrid work making our neighborhoods more central to our daily routines, you have to wonder, is the local suburban mall no longer a relic of the past, but actually becoming the future of community and commerce, more essential than it's ever been before?